In this video, I'm going to show you exactly how I read charts. We're going to break it down to its simplest form. It's not rocket science. I'm going to show you exactly how I do it. Stick around. I know you're going to like this one. Hey, welcome back everyone. It is time for another red hot covered call video. Well, hey, look, today we're going to talk about how I read charts. And to tell you the truth, it is not rocket science. I'm going to show you some of the key things you should be looking for, and I'm going to show you a potential setup for a trade that I'm going to do this week. If you've never been to my channel and you like what you hear, I want you to subscribe to the channel. It's right there. I come back every week, show you timely and relevant covered call trades, hoping to up your game. And hey, look, if you like this video today, bang that like button. It lets me know you like what I'm doing. Now what I'm doing is this. I'm going to show you some very basic chart reading skills. And quite frankly, you already know. You already know half of what I'm going to say. See, we don't have to have this high skill level of reading charts. For the most part, we have to have guidelines. And I have guidelines. Guideline number one. Let's grab a piece of paper and a pencil. Let's write these down. Guideline number one. We want to get involved when stocks are trading in the lower range of their trading range, right? We don't want to be getting involved when they're at the top because we know stocks ebb and flow. And when they ebb, meaning they move up, Wall Street is running them up. And when they flow down, Wall Street's taking profits. So this is what happens. This is why a chart is not straight up or straight down. Stocks move and Wall Street buys them and sell them, taking profits. So it's when we get involved is the most important. We always want to get involved when it's trading at the bottom of its range. I use Yahoo. I'm going to use all the defaults when I start to look at a chart using Yahoo. There's no special sauce here where we pick the 1 day, the 1 minute, the 1 second. No, we're going to use typically the 1 year, and we are going to use some indicators that help me paint a picture. So we have guideline number one. You already know that. We want to get involved with stocks when they're trading at the lower part of their range. Now, that sets up for our next indicator we want to use, which is the RSI. The RSI is used across Wall Street because it typically shows if a stock is oversold or overbought. And usually oversold, the RSI is going to be anywhere near 20. If it's overbought, the RSI is going to be near 70 to 80. So what we're looking for is an RSI that's under 50. If it's at 50, that's usually a Goldilocks RSI, meaning it's not too hot, not too cold, right? I love an RSI that trades below 50. In the case of Texas Instrument, this is going to be the stock we're going to talk about because I am going to take a position this week. The RSI is trading at 39 right now. So that's more oversold than overbought. That means Wall Street's looking at it and they look at it as a value play. It clearly is trading in the bottom of its near-term range. And the way I look at charts is we are going to pick the near-term range, generally a year, and then we look to back out if we need to. But for the most part, because we have all of these little bottoms, right? We have these little bottoms that indicates support. That would be support for the stock. Now, we need to draw lines, and that's what we'll do here with Texas Instruments. We're looking to draw lines of support. Every time it touches a bottom, we want to find this consistency that could be support. Meaning, Wall Street's selling it off, and when it hits this line of support, Wall Street comes back and has proven they'll buy it up. Texas Instruments clearly has that. You can see it right here. With recent trading, it has touched this bottom at least 3 times and is trading at the bottom now. So we have an RSI which is trading under 50, and that would be guideline number 2. If I'm going to get involved with the stock and open a position, I want the stock trading in the lower part of its range. I want the RSI to be less than 50, which means it's more oversold than overbought. I'm not buying in with the fluff. See, when people buy in here, that is usually when the stock is a little fluffy. Wall Street has rallied it up. They're going to take profits. We are left holding the bag. I would rather buy at its low because it's more favorable that the stock would go higher than lower. Now, we don't have a crystal ball, so at the end of the day, the stock could continue to fall because had you thought that was the bottom right there, you'd have been stuck holding this bad boy when it falls there. So really, these are all about guidelines. And if we follow the guideline, then chances are we're going to put ourselves in a more favorable position than we would have had we bought up here. Okay, so we have two guidelines in place now. Now, I love to use the Keltner channel. This is an indicator that shows a stock's trading range. So as you can see, the Keltner channel looks very similar to the Bollinger Bands. Now, the Bollinger Bands act a little different because the Bollinger Bands will show compression in a stock move, which can ultimately predict whether a stock goes up or down. The Keltner channel is not that. It's all about its trading range. So when we bring up the Keltner channel and we use the default settings in Yahoo, you can see where these borders are, right? You can see this is the top side of its trading range and this is going to be the bottom side. So with that middle already in place, what do you think I'm going to say? I'll tell you what I'm going to say. I want to get involved every time it's at the bottom of that middle line. Because if this is considered the stock's trading range, we're going to get movement lower and we're going to get movement higher. I want to be buying when it's moving lower. If you believe this is a stock's trading range, we're going to have these ups and downs, and we want to get involved when it's trading in the down cycle. That is guideline number 3. Guideline number 1, buy in the lower part of its range. Guideline number 2, RSI, we want it under 50, preferably under 40, because that means the stock is more oversold than overbought. And we want to use the Keltner channel. Keltner channel tells us what the stock's trading range is, and we can see the middle of its range. And when we see the middle of the range, we want to get involved when it's trading at the bottom of its range. Because again, it should trade in the higher part of that range. I mean, again, you have to buy into this. If you don't, then this probably isn't a good indicator to use. Now, other YouTube videos will talk about the MACD and all these other things. What I'm telling you is this. We don't need to be rocket scientists to get this. Now we're looking at support and resistance lines. Kind of goes back to trading at the top of its range and the bottom of its range. Notice here, we have support lines, and it's very faint, but you can see them here. Wall Street will look at a 20-day simple moving average, a 50-day simple moving average, and a 200-day simple moving average. The 200-day moving average is usually the low of the low. Okay, if you're going to get involved with a stock and it's trading at its 200-day, getting kicked in the NAD's moving average, something could be very wrong with the stock. So you want to do your research and find out why it's trading in this sideways to higher overall stock market this year. Why is this stock trading at its 200-day moving average? Which means it's trading low, and quite frankly, it's probably trading at its lowest point. Now that seems like a good time to get in, buy low, sell high, but again, you have to do your research. The 200-day SMA usually is the last line of support for stocks. If it breaks the 200-day SMA, meaning it goes below it, you don't know where the bottom's going to be. So be careful with the 200-day SMA. Now, with that said, that could be a good point to get involved. Again, we're trading great stocks with profits. So this could just be a moment in time where the stock is selling off. Maybe Wall Street didn't like some earnings. 200-day moving average, lowest of the low. And if the stock isn't collapsed, that could be a good point for me to get involved. Buy low, sell high. Notice Texas Instrument here. This thing has a resistance of 185. That's not resistance. See, the stock is now traded lower, hitting support, and you can see it bouncing off this support. Wall Street must like that right there. It loved how it bounced off of this back then, and if you drew this line back, it bounced off of it back here. So Wall Street loves this line of support, which looks to be around 165. You can see it right there, 165. Now, with every other move, it can dip below 165, and it has recently as well. That's not a deal breaker. Just understand, we're trading near support. we get involved, it's more likely or more favorable it could go higher, just like in the past. Now, I just mentioned that 185 is not near-term resistance. By the way, resistance. When a stock tries to break through out of its last near-term high, and it does not, that's resistance, right? It's trying to break through, it's not, that's resistance. Well, once it breaks through resistance, a lot of times that can now become support because the stock is now moving higher. Well, in this case, we're not doing that. You could see around 185, we have 3 points where Texas Instruments tried to break it. Didn't happen. It almost did here, but it didn't hold it. And look what happens. News, earnings, anything can happen right here. We're talking over a 20-point fall. Okay, so it did not break resistance, and this is not the new support. Now this sucker's trading in the 160s. So this thing hopefully is going to trade off of support, and it's going to try to break 170. And it may fail. It'll try again. It may fail. And then it may break through. And then you have to look at the chart as if you're a drone, right? You have to back out a little bit. You have to see the forest through the trees, because this is a very tight trading range. Once it breaks 170, if it does, now you have to go back and see what the next line of resistance might be. And in this case, without spending much time on Texas Instruments chart, I could tell you right now, if it finds itself bouncing off of 170 and it actually breaks 170, you could see it had this terrible move here that it has to backfill. So this area right here is a huge backfill moment. If you look back, we had little moments of resistance right there. You know, get rid of this, because those mean nothing now. Because now we're at the bottom trying to find our way up. So here would be your next resistance point, around 180. And again, here it is trading as support. It breaks 170. This needs to be backfilled because the fall here is tremendous. There's no support, no net whatsoever. It goes from 185 to 165. Now as it starts to trend and move higher, breaks through 170, that's your first line of resistance. What is the next line of resistance? It's going to be 180 and then ultimately 185. So we're looking for support. And when we back away from the chart and we draw these lines of support, you could see that Wall Street will support it when it falls from 185 all the way down to 165, buys it, sells it, buys it, sells it, buys it, sells it. So we're developing support. Wall Street's starting to feel comfortable with that line of support. Wall Street will start to look at things like the SMA 20, the SMA 50, and the SMA 200. Well, Texas Instruments in a spot where it has fallen such that these do not matter. And maybe you could say that SMA 200 matters because this thing has fallen 20 points from 185. So here are all those SMAs. And you could see it's clearly not trading in that range. It can't find its way out of 170, which is our first line of resistance. So these SMAs right here are really not going to help us. So here's our guidelines. I want to make sure I'm taking a position in the lower part of its range. I want to make sure the RSI is 50 or below. I want to make sure I find a line of support, and is Wall Street bouncing it off that line of support? Because that gives me comfort that if I get involved here, there is a chance there's some buying. Because again, I'm going to go back. There's no crystal ball. Nobody has a crystal ball or else everybody would be rich. So we're looking for lines of support. Then what we're looking for are resistance lines, because then we could start taking on trades and we can somewhat look at the expected stock move over a certain period of time. If you're going to sell premium against these shares, like I will this week, I want to know where the support is and I want to know where the basic resistance is. Because the initial trade, the initial move this week or over the next 30 days is to test that 170 mark. So if I feel comfortable that it's going to try to go to 170, I'll get in a position at 162 and maybe I write that 165 or 170 out of the money covered call, because I know its resistance is 170. So that's helping me pick strike prices when I sell premium. Now I'm going to leave you with one of the most fundamental, easiest ways to read a chart. It's quite simple. What we do is we look at where a stock's trading now. If it is trading in the lower part of its range, we merely just draw a line back and go back as far as you can to identify these points of support. Let's talk about this chart. This is a 1-year chart. Look what happened. When Texas Instruments breaks above this resistance, it's now moving and trading up here. Falls down. Where it falls down is to its next line of support. Now, we don't know if that's its next line of support because it doesn't necessarily trade there for a couple days. It literally bounces off and moves back in to its old sandbox. So you might think that is a line of support. Some might actually think this is the line of support because a stock can trade below its line of support and still keep it. But in this case, it falls down, literally looks like a week, it bounces back up, it's back in the same sandbox. So now you're trading it in this sandbox and it rallies, it breaks resistance a little bit, comes back down, there's your support again. So now you're thinking that's near-term support. It rallies off of that, looks to break a little bit of resistance, it doesn't, and then look what happens. It falls down to this line of support. So when it bounces off of this and it's heading higher, I, as a stock trader and a chart reader, I can see now that this is near-term support, and if it breaks near-term support, guess where it's going? It's going to find itself right back to the long-term support. Okay, so when I'm setting up my trades, that's how I see this. This is like chess, man. This is your first bottom, and it's almost like making 2 moves in chess. Here's my first bottom, but really here's the second move. So we want to be prepared to find that second or long-term support. So Texas Instruments sets up beautifully for me because as it plays in this sandbox, we do have this line of support, and guess where it's trading right now. So I am going to play that. I'm going to actually get involved here because it is very likely that it could act just like it did before. And if anything, I feel like I've done what I've had to do to put myself in a more favorable position when taking this position. Finally, take a step back. Take a step back and look at the forest through the trees. Looking at this chart after watching this video, where's support? It's right here. So what we're going to do, we're going to play that line of support with the understanding we don't have a crystal ball. And this thing could actually find itself down here. There's risk in everything, right? When we use these very simple guidelines, it can really help us find a more favorable entry point. We can feel that if anything, man, the fluff is sold out of the stock. And maybe with the great companies we're investing in, Wall Street will see them as value plays and run them up. I think at the end of the day, all of this stuff is meant to confuse everybody. I mean, really, come on. They have websites that you could have 1,000 indicators. And look, if you're a day trader looking to scalp a penny here, penny there, yeah, maybe you do want to look at a per minute trade chart. When you're looking at a 30-day trade where you might buy the shares and write a covered call, you don't need all that. You basically need what I outlined in this video. Look, if I went too quick for you, watch it again. And hey, you can always YouTube simple chart reading. And quite frankly, you're going to find that most of the things I talked about here today are relevant with all these other traders. But some of you may not want to get involved in all that rocket science type stuff. So that's how I do it, and I'm pretty darn successful. Try to find your guidelines, and if anything, man, if anything, just try to enter your positions lower so it'll give you a more favorable chance for the position to go higher. Hey, look, I'm pulling for you. Be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable. Let me break real quick from the video. The new Poor Man's Cover Call Tracker is out, and what I would like you to do is support me with a great cause. One of the things I've done over the years is I've given away all my spreadsheets, including the free Poor Man's Cover Call Tracker. That tracker is very basic. It has really no calculators outside of the initial trade setup. Over the years, I've realized you need other tools integrated into the tracker to really set us up for success when we use the poor man's covered call. So I've updated the tracker with all of the things integrated that help us get closer to success. What I would love you to do is support me in a great cause. I want to go ahead and give you access to the new Poor Man's Covered Call tracker, but we're going to do this where we donate to a great cause. If you donate, I'll give you access to the new Poor Man's Covered Call tracker. I'm going to donate once a month 2 things. I'm going to donate to the Pancreatic Cancer Action Network. I've had 3 people in my life pass away from pancreatic cancer, and there's no cure. So over the years, I've realized that what's the money worth if you don't feel like you're contributing? At least that's how I feel. What I want to do is contribute. I want to contribute to a cause where I feel like maybe I'm helping in just a little way. And this is the best way I know. So what I'm going to do is this. If you donate, I'm going to give you access to the new Poor Man's Covered Call tracker. And what you're going to find is I'm going to include a tab in there that includes Poor Man Covered Call resources, and I'm going to integrate a lot of my Poor Man Covered Call trades into the tracker. And you'll see it in upcoming videos that I do and showing you the tracker. Now, I'm also going to give you one free month of the upgraded CTP membership. Yeah, that's right. You donate $9.95 today, you're going to get both the new Poor Man's Covered Call tracker, and you're going to be added to my upgraded CTP dashboard membership list for one free month. You're a full member. This is your chance to both get access to the new Poor Man's Covered Call tracker with all the integrated tools that get us closer to a successful Poor Man's Covered Call trade and managing it. Plus, you're going to get one free month, no obligation, to my membership. In the description is the link to this page. What I'd love you to do is consider donating to a great cause so I can welcome you aboard. I want to say thank you in advance to all that will support me in this cause. Now let's get back to the video.